it's in line with CAPM and also cost of capital. But before I dig deep into these calculation numbers, you need to be aware that with CAPM they can ask the theory. What is all about this model? This is a financial model. This is just for a summary. This is a financial model used to estimate the expected return on an investment based on its systematic risk. Yesterday we discussed, we talked about all these things. What is a systematic risk? What is unsystematic risk? Yesterday we talked about that. So this CAPM is just a model we use to estimate the expected return on an investment based on its systematic risk. Systematic risk is like the market risk. Okay, so that is the CAPM. If you are to define it, it just shows the relationship. It shows the relationship between risk and return, and helps investors determine whether the investment is fairly valued. Okay, that is the CAPM. That is the CAPM. If we are to look at an investment, if we are to look at an asset, is it well valued or it is undervalued? Is it overvalued or undervalued? So it will help us. This CAPM. It will really help us. Okay. And as we discuss the CAPM, you are going to see that there is a formula that we use. There is a formula that we use, and this formula is what? The CAPM formula. The CAPM states that the CAPM, when we are looking at the CAPM formula, the CAPM states that the expected return on the expected return states that the expected return on a security is equal to risk-free rate, then plus the beta, then times what? Times the market risk premium. But as we are going to see, risk premium is equal to return on the market, where risk premium is equal to the return on the market, then minus this is the return on the market, then minus the RF, risk-free rate. That is risky That is risk premium. So in short, when you're using CAPM formula, your expected return on a security will be RF, will be your RF, risk-free rate of return, then plus the beta, plus the beta, then times, this is time plus the beta, then times this everything you multiply by what? Everything you multiply by the risk premium. Everything you multiply by the risk premium. That's how you get the expected return using CAPM. That's how you get expected return using CAPM. It's a very is a formula. I don't think that you will have problems. And of course, this topic may not miss in your paper. It's a core topic. It's a core topic which you should try to master. Okay, so that is the CAPM formula. That is the CAPM formula. You may use the CAPM formula to answer, because they can, from the CAPM formula, they can ask a lot of things. Maybe they can ask you get the risk-free rate of return, and they have given you everything, or you get the beta and you have everything, or you get the risk premium. So just that in your exam, you just need to open your mind and read the case study. Know what you're given and what you need. Okay, that is our CAPM formula. Risk-free rate is just the return from the risk-free investment. That is like treasury bills. I don't know whether you are aware, but those government securities like treasury bills are risk-free. When you invest your money in those securities, the probability of losing your money is very minimal. It's very minimal. That's why we say that the investment in government securities are risk-free, because you as an investor, the risk of losing your money is very, very minimal. Very, very minimal. That's why we say it is risk-free. And now with CAPM also looks at investments like those government securities. Now, when you're looking at beta measures the asset sensitivity to movements in the market. This beta you see, it basically measures this beta that you see here. It basically measures the assets. When we say the assets, in this case, it could be the investment, the asset sensitivity to movements in the entire market. That is your beta. Not B. Your beta, not B. Your beta. Okay. Then market return is just basically the average return of the market portfolio. What is the average return of the market portfolio? Then risk premium is basically the extra reward investors expect from taking the market risk. It's like the compensation investors expect for taking this risk, the market risk. That is risk premium, the extra return, the compensation that investors expect from taking the market risk. So generally, when you're looking at CAPM, CAPM helps us to answer this question: how much return should I expect given the level of risk I am taking? That is CAPM. How much should I expect? How much return should I expect given the level of risk I am taking? The only risk you're taking here is the market risk. So what do you expect as your return? That is you're going to use CAPM to get that. Simple as that. You are going to be asked to explain the assumptions. You're going to be asked to explain the assumptions of CAPM. And you find that it is taking like 6 marks. Explain the assumptions of CAPM. I believe those who have been checking in your QB, you must have seen this. One is that as we look at CAPM, we are going to say that the beta it assumes that the beta is the only risk that matters. What do we mean? Only systematic risk. And as I said, that systematic risk is like the market risk. Okay, so only systematic risk, this model assumes that only systematic risk influences the required return. This is just the assumption in simple terms, and meaning that for this model, the firm specific risks, the firm specific risks, that is systematic risk. When we say the firm's specific risks, that is like diversified risk or systematic risk. Okay, so the firm's specific risks are assumed diversifiable. That's the reason why this model does not consider the firm's specific risk. It only focuses on only what? On only the systematic risk. It assumes that the firm's specific risks are okay. I think here I'll be repeating myself. This model assumes that depending on how you want to start, you can simply say the firm specific risks are assumed diversifiable. But even if you put the point like this, you'll get your mark. Okay, that is assumption number 1. It only looks at systematic risk. Remember, beta is the one that helps us to measure this systematic risk. Okay, then also another assumption is that all investors, it assumes that all investors hold diversified portfolios. All investors hold diversified portfolios because diversification eliminates the unsystematic risk. That's about this model. It assumes that these investors already hold the market portfolio. Remember, portfolio, we mean what? You have different investments. You maybe as an investor, you have different investments in a way that if investment A is not performing well, the other investment may be performing well, and the loss you make from investment A can be compensated by the gain you made from investment B. That's about what? This assumption. Okay, so this assumption doesn't look at any systematic risk. That is assumption number 2. Then next, we assume that no taxes or transaction costs. Assume that no taxes or transaction costs. How? Here, buying and selling securities, It assumes that as you buy your security or as you sell your security, you are not going to incur costs. You are not going to incur costs. Okay. Taxes and taxes do not influence the return. That is assumption number 3. But you guys, are you on? That is assumption number 3. Then you can also put asset markets. Asset markets are perfectly competitive. That is another assumption. That is another assumption. Okay, that is another assumption. It assumes that asset markets are perfectly competitive. What do we mean here? No single investor can influence the market price. That's what we mean. In short, here we are saying that investors are price takers. You just need to go with what is in the market. Okay, you don't need to influence. You don't have that capacity. The market is just competitive in a way that you just need to. If you invest, you just invest. You just invest. That is number 4. Number 4, I believe these points are easy to recall. It also assumes that here we have the risk-free rate and the market return. It assumes that the risk-free rate and the market return remain constant. That is also another assumption. It assumes a stable economic conditions. That is another assumption. That is another assumption. We have many assumptions, but I think these can be enough. This can be enough. We talk about it assume that the markets are efficient. The markets are efficient. That is another assumption. All investors have equal access to information. In short, we are saying that the securities are fairly priced. There is nothing like there is no under or overvaluation. Because we assume that for you are not going to, as an investor, you are not going to invest because the other security is underpriced or is undervalued. No, if everyone who is going to invest is aware of that. Yeah. So you all have the information. If the asset is undervalued, you'll be knowing. If the asset is overvalued, you'll be knowing. And you can just make the decision. Okay. Then lastly, I think the last point here, we assume that investors are rational. Investors are rational and risk averse. What do we mean here? They prefer less risk. They prefer less risk for a given return. for a given return. They only invest, they can only invest in a risk asset or in a risk investment if they expect a higher return. Okay, so I think these points are easy to recall if they ask you the assumptions of CAPM. These points are very easy to recall. There are many, there are really many, but investors can borrow or lend, at the risk-free rate. Assume that everyone can take a loan, at the same interest rate as the government treasury bills. Because we say that this government treasury bills, it is risk-free. So also here, this model assumes that these investors can borrow or lend at the same rate like the rate on government treasury bills. But of course, in real life, this is impossible. In real life, this is impossible. So those are some of the points, guys. Let's just stop here, but I could like 10 investors share the same expectation. Everyone forecasts the same risk returns and correlations. So they make decisions using the same assumptions. That is another point, that investors share the same expectations. That is another point. Investors share the same expectations. Expectations like what? Everyone forecasts the same risk, the returns, or the correlations. Okay. All right. All right, those are some of the points. But there are other points. Just that because of time, I may not list. But I believe in your exam you can get like five. You can recall like five points. Okay. Then okay. The theory you need to understand is the merits. You need to read about the merits. Do you think that this CAPM has some advantages? Then also you need to read about the limitations. You need to read about the limitations of this model. Very common question. Explain the limitations of CAPM. If you need, I can explain. But I think if you don't need, we can just go and do the calculations. But if you need, I can explain all these things. Okay. Do you need we highlight on this, or we just go to calculations?
We highlight on them.
Okay. So when you look at, let's say, when you look at the merits, if they ask you the merits, you can talk about one of the merits could be it is easy to apply. It is simple and easy to apply. Now at this point, colleagues, don't put this point if you know that you are not going to answer the calculation number. How can you say that it is easy or it is simple and easy to apply, and you cannot even use it to answer the question? There are some points you don't need to put. Okay, we assume that this model, the reason why we are saying that it is simple and easy to apply, it uses only one formula. It uses only one formula. Making it easy for students. for students, for the analysts, and the managers. That is point number one. At least you see this formula, you can recall it. It is not all that complicated. But I repeat, don't put this point if you know that the calculations, you cannot apply the concept, you cannot apply the model. Don't put. Don't put. You rather put other points. Okay, it focuses. Another thing is that it helps. It helps in valuing the investments. It helps in valuing the investments. For example, it is used. It is used to compute. It is used to compute. It is used to compute cost of equity. You know that when we are computing the cost of equity, we can use the CAPM formula or Gordon's model. We can use the CAPM formula or the Gordon's model. So it means that you can rely on it because this cost of equity is normally applied. It is normally applied when we are appraising the projects. The project appraisal in the project appraisal, that is capital budgeting. In a capital budgeting, you remember, let's say when you're determining that NPV, when you're determining that NPV, we normally use that cost of equity. That is cost of equity, cost of capital. We normally use the cost of capital. Yeah, I'm trying to put. Okay, that is another point you can put. It helps in valuing the investments because as you value the investments, you're going to use this cost as in the process of valuing the investment. You need to use cost of capital somewhere. You need to use cost of capital somewhere. So you can use CAPM to determine that cost of capital. Okay, it is useful. It is useful for performance evaluation. It is useful for performance evaluation. Here it could be about the funds or shares. Or shares can be compared to the risk they carry. That is something that if a fund with a higher beta, you need to know that a fund with a higher beta should earn a higher return. At least you can relate it in that way. It encourages diversification. It encourages diversification. That is another point you can put. It encourages what? Diversification. CAPM suggests that these investors need to what? Okay, it suggests the efficient. I believe you have heard the efficient frontier and the market portfolio. Are giving investors, guiding the investors to optimize the risk return. Okay, that is another point you can put. Among others, it could be about good for comparing the companies. It's good for comparing the companies. Beta allows analysts to compare risk across industries and firms. That is another point you can put. I believe that's all for now. let's just pause on that. Let's just pause on that. Maybe another point you can put, it links risk to return clearly. This model provides a straightforward relationship. Hmm? Here, the higher the higher the risk, the higher you expect also the higher you expect the high the higher the risk, the higher the expected return. Okay, so that's what you can put. If you can recall like 4 points, the better. If they ask you the relevance, the merits, you put all this. Okay, then of course you can search and get more points, but let me pause here. Then limitations come from assumptions. If you can recall the assumption, then it becomes easy for you to put the limitations. But limitations is that one of the limitations is that it ignores investor behavior. It ignores investor behavior. Investors emotion. It could be like panic. It could be like greed. Affect the markets. Affect the market. But this model, but the CAPM assumes rational behavior. You know that some people invest based on their based on how they are familiar. Others may be in panic to invest in something. Remember, if you're greedy, if you're in panic, all those things can affect you can end up not considering the right investment or choosing the right project. So this model does not look at the behavior of the investor. Which is sometimes there are those people who don't invest in some particular businesses. There are some people who don't invest in some businesses. So that is number one. It assumes then we can also say that it assumes perfect markets. Now, this is an assumption. This is a limitation. It's an assumption, but at the same time, a limitation. In real life, real markets, however, real markets have taxes. Have transaction costs. As you sell or buy, you're going to pay. It has insider trading. There are some people inside the government, those who work within the company. They may be knowing much information compared to the outsiders. Yet the CAPM say that all investors have the access to all the information, which may not be true. Those guys who are inside, those guys who work within, have much information about the company compared to those outsiders. You have the regulations, among others. There is no way you're going to say that it is a perfect market when there are all these things. So therefore, the CAPM becomes less realistic. That is another assumption. That is another limitation. That is another limitation. Then, of course, you may also say that it only considers the systematic risk. It only considers the systematic risk. It only considers the systematic risk. But in reality, we have many. We have other. In reality, we have there could be other. In reality, there are other. There are other risks. There are other risks like what? Like the political risk. The political risk. The political risk. The like the liquidity risk. The liquidity risk. It could be about the currency risk. Okay, and then maybe currency, inflation, etc. Other risks, or which affect the expected returns, but are not included in CAPM, So that is another limitation. It also uses the historical. Market data. To estimate beta. We use the historical market data to estimate what? Historical market data to estimate beta. That is another limitation. Remember, the past data may not reflect the future risk. That is something that you need to know. This thing of it looks at the market portfolio. The thing of this market portfolio is theoretical. Because it assumes that these guys invest is the market portfolio. It assumes these guys have the portfolios, but it is theoretical. Well, in actual sense, we needed to know that the actual market portfolio cannot be observed. You're just assuming. Because here as you analyze, if you go deep, you will be using those indices. Analysts normally use proxies like stock indices to assume, which may not be perfect. So it's also something that you need to highlight on. Okay. I think these points are enough. You may talk about the poor estimation of the expected market returns. The market risk premium. The market risk premium is hard to measure. And often subjective. So sometimes as you do that, because you're relying on the estimation, sometimes it becomes very, very hard. Okay, those are some of the limitations. It does not consider changes in economic cycles. That is another limitation. This beta you see here, beta may behave differently during during recessions or booms. But this model does not consider all those things. Okay, I think that's enough. That's enough. If you can recall 4 to 6 points, that will be enough for you. So I am done with the theory. Let's now look at some of the computations. Let's now look at some of the computations. But you may add other points. You may add other points. So when you look at this computation, we are told to calculate the betas for portfolio A and B. You have 3-4 marks. Okay. Then after that, you analyze 2 portfolios and determine which one is more risky. The one which is more risky will depend on the beta. Okay. Then part C, we calculate the expected return. On portfolio A given a risk-free rate of the 12% and at 20%. So what are we given? We are told that Tambogo University is considering investing into a project with a portfolio of 5 assets each. She is attempting to evaluate particularly interest in using the beta. Interest in using the beta to compare the risks associated with the portfolios. The university has gathered data on the 2 portfolios as shown in the table below. You have the assets, you have the asset beta, then you have the portfolio A and B. A and B. Okay, so how can we get betas? How can we get betas for portfolio A? It's really very easy. You may use the table, or you just draw on the face, because here as you get the betas, for the portfolio A, this is A. You have the returns. These are returns. So you can simply let me just a minute. Give me just a minute. I open this. Just a minute. Okay. So here we have now when you're in an exam, you need to compute part A. We are told to compute the beta, the betas for the beta for portfolio. We need the beta for portfolio A. How are you going to get this? One student may use the table and another student may just aggregate. One student may say, I open bracket here, I get 0.9 times the return, which is the first return, which is 10, then plus, I open bracket, I get 1.1, then times the 30%. like that. Okay, that is one student. You may decide to use that approach, or for you, you may use the table. Just use the table. You put here your assets. You put here your assets. This is A, B. This is A. This is A. This is A. Just a minute. This is A, this is B, this is C, this is D, and this is D and E. Then I can put my asset betas, my asset betas, my asset betas, my asset beta for each asset. Then I can put now the returns, the portfolio, the portfolio returns, portfolio A, portfolio A. So I will need to get the average. I will need to get the average beta, which will be here the beta, the overall beta, the overall overall beta. How do I get this? What is here? It is 0.9, 0.9. Then here I have 1.1. I have 1.15. I have 0.8. 0.8. Then here I have 1.3. I'm picking this from the what? From the question. From this question, I'm picking this. Then I put these ones where I have A. Where I have A, I put this is 10%. This is 10%. 10%. Then here you have the 30%. The 30%. Then you have the 10%. Then you have the 15%. Then lastly, you have the 35%. Okay. Now, in an exam, you need beta. Now, what do you do? Simply multiply. Simply multiply. You get this times this. This is what I get. This is what I get. I also get this times this. On your calculator, do you get these figures? On your calculator, what do you get? Are you getting these figures? Round off 3 decimal points. Round off 3 decimal at 3 decimal points. 3 decimal points. Or 2. Depending on your time, I can use 2. I can because of the time in an exam. So the beta, the overall beta, I add the sum of these figures. The overall beta I add. When you use your calculator, do you get this? You guys don't just copy. Don't just copy. Make sure that you're using your calculator. When you use your calculator, do you get this? When you get this time this. Okay, so that is your beta. That is your beta. That is your beta for portfolio. This is beta for portfolio. This is beta for portfolio. For portfolio A. This is our beta for portfolio. The beta for portfolio A. And you're done with the first. Then you do the same for the other part. You do the same for the other asset. You do the same for the other asset. Where there is A, I put B. Where there is A, I put B. The only thing that is going to change are these ones here. These ones are going to change. But the beta is the same. So here, when you look at your question, you have the returns. These are returns. So you be multiplying. So you have here, you have 30, this is 30%, this is 10%, then this is 20%, then this is 25%, then the last one is 15%. Okay, so when you multiply, you get this times this. That's what you get. Round off 2 decimal points to avoid wasting time. If you aggregate, what is the total? That is the total that you get. So that is your beta. That is your beta for portfolio B. And you're done. You're done with part A. You're done with part A. Any question on part A? I would recommend you use the table. This approach, yes, it is okay. It is okay, but if you use the table, you're smart. You're smart. Okay. Okay. That is part A. Part A. This is part A. This is part A. This is part A. Then next, what are we told? We analyze the beta. We analyze the two portfolios and determine which one is more risky, and explain why so. You explain why so. You explain why do you think that it is more risky. Now, when you are analyzing, you just need to know that we use beta. Just for summary purposes. We use beta to measure the risk, to measure the systematic risk. Now, take note that in a scenario where beta, I think, let me use this side. Let me use my workbook. Let me use the other. Okay. What's the manual? Are you seeing, which screen are you seeing? The Word or the Excel? Or which one are you seeing? Okay. We use beta to measure a systematic risk. Now, in a scenario where you find that your beta is equal to 1, what does it tell you? Where beta is equal to 1, it shows that it has 1 times the risk of the market. It is 1 times the risk of the market. That is what we normally call it has the same risk as the market. In short, here you are saying that the portfolio has 1 times the risk of the market. The portfolio has the same risk as that of the market. That's what we mean. Then, if this beta is greater than 1, what does this mean? It will mean that this will mean that it is more risky. It is more risky it is more risky than the market, If you find that your beta, is greater than 1, that one shows that it is more, the portfolio is more risky compared to what? Compared to the market. Okay, then next, in a scenario where you have beta, that is less than 1, where beta is less than 1, what does this one mean? It will mean that it is less risky. Less risky than the what? Than the market. Risky than the market. Okay. Then finally, if you get the beta, which if you find that your beta is equal to 0, what will that one mean? If beta is equal to 0, if you compute and realize that your beta is equal to 0, it will show that the portfolio has zero risk. Okay, if you compute and you get beta as equal to 1, it means that the risk of a portfolio is the same as that one of the market. Okay, so from this, what you're going to do now, it is to analyze. You just analyze your question. And see. Now we want to identify which one is more risky. Which one from these two portfolios? Which one is more risky, and why? Which one is more risky and why? Okay. Sorry. Which one is more risky and why? So we are going to say that, of course, from our template, from our summary, the portfolio which is more risky will be that one which has a beta that is greater, that is more than 1. If you find that your beta is greater than 1, then that portfolio is more risky. So which one is more risky? Who can tell me from this? Which one is more risky? A or B? B or A? Someone in the chat is saying A. Yes, A. Yes. So we are going to say that a portfolio A is more risky since it has a beta. Since it has beta, I put the beta in bracket 0.5, which is greater than 1, compared to portfolio B with a beta of we are done with part B. So whenever you're commenting always look at the betas. If a beta is less than 1, that is less risky. If a beta is greater than 1, that is more risky. If all are greater than 1, all will be more risky, but of course, the one with a higher risk will be that portfolio with a higher beta. Okay. So if you realize that, let's say this one is greater than 1 and also this one is greater than 1, the way you comment, you say that both portfolios are risky, but let's say portfolio A is more risky. Compared to what? Compared to, you will say that since both portfolios, okay, since, how can I phrase it? Both portfolios are risky since they have a beta greater than 1. However, portfolio A is more risky with a beta of, you put a beta compared to the beta of portfolio B. So you just phrase your statement very well. You phrase your statement very well. Okay, so that is Roman 2. Then next, we are done with Roman 2. Roman 3, we are told to calculate. We are told to calculate the expected return on the portfolio A, given risk-free on portfolio A. Now they are specific. Portfolio A, given a risk-free rate of 12% and market return of 20%. So how do you get this? You are going to simply say that Roman 3, using CAPM formula, remember the CAPM formula say that expected return is equal to what? Risk-free rate plus the beta, then times RM minus RF. That's how you get the expected return. So for portfolio A, since the question is on portfolio A, I am going to say that for portfolio A, we are given, first of all, our beta is what? For portfolio A, our beta is 1.05. Then what is our RF? The one given in the question. What is RF? The one given in the question. RF is 12%. Then RM is 20%. RF is 12%. Then RM is the 20%. So substitute in the formula. Our expected return for portfolio A, expected return from portfolio A will be RF, which is 12%, then plus beta, which is 1.05, then times the 20% minus the 12%. What do you get on your calculator? What do you get? On your calculator, what do you get? Someone will please tell me. As you use your calculator, don't put percentages. Just put get 12 plus here you'll be getting, okay, for me, you can use the percentage since it is the calculator. But for you on your calculator, simply get 12 plus 1.05 times open bracket 20 minus 12 close bracket equal sign. So what do you get? Someone in the chat is saying what? 0.204. So in percentage multiply by 100. This is 12% plus 1.05 times the 12% minus the 20% minus 12%. Okay, that's what you get in percentage, because your answer must be in percentage. So in percentage, I have something like this. So that is your answer. That is your answer. That is your answer for this question. That is your answer for this question. You see how it is easy? You see how it is easy? So that's how you get the answer. That's about our question. We are done with that. How many marks? You have 10 marks so far. You have 10 marks. Clean one. You can score these marks within 10 minutes. You know what you're doing. Part B now. Part B is when you look at part B, you are told that the following, okay, required part, compute the equity beta for Godson Export Commodities. For Godson Export Commodities Limited, equity beta. Now, which information are you given? Which information are you given? From what we are given, we are told that the following information relates to Godson Export Commodities Limited in year 2022. You have the current price per ordinary share capital. Colleagues, when you are dealing with the cost of capital, when you are dealing with the CAPM, and you start looking at the issues related to the current price, issues related to dividends, we don't use dividend in the CAPM formula. So the moment you see dividend, your mind should immediately think about Gordon's model. Gordon's model, not CAPM model. You use Gordon's model to get the cost of equity, and you will substitute that cost of equity in the CAPM formula to get equity beta. Gordon's model, I hope it is not the first time to hear that word. If someone is called Gordon, we are not meaning you. You are from the Gordon's model. From the Gordon's model. Someone here who is called Gordon, this is not your model. Another Gordon's model. Gordon's model says that from when we are computing cost of equity, or return, it could be the return depending on how you want to call it. Cost of equity, which is like KE, which is like KE, is equal to, just I'm stating the formula. Is equal to what? D1 is equal to D1. Just a minute. Is equal to what? D1 is equal to D1 is equal to D1 over P naught. I'm going to tell you what is P naught, what is D1 over P naught. Then add the growth, the dividend growth rate. You add the dividend growth rate. So this is Gordon's model. This is Gordon's model. Remember CAPM. Now, when you look at the question is asking you to determine what? The question, the examiner is saying determine the equity beta. Now, using Gordon's model, you don't have equity beta in the formula. So it means that for you to get equity beta, you will also need to recall that here using the CAPM, capital asset pricing model, the formula is this one. The formula is this one, where you have expected return. You can put KE. You can put KE here. I take it. Sorry. But then just a minute. Okay, just sorry. Just a minute. So using CAPM, KE, cost of equity will be this. So these are the formulas for your case. For your case, they cannot ask beyond this for your case. So at least as you enter into your exam, be knowing these formulas. Be knowing these formulas. Depending on what the examiner is asking, you will be in position to get N. Because if I need beta, equity beta, it is this one. This is what I need. This is what I need. Equity beta is this one. This is what I need. Okay? But how can I get equity beta? How can I get equity beta? In a question already, you see that you have issues related to the current market price. Now, I will use the Gordon's model first of all to first get KE. Okay? Now, let me first define these things before we move on. What is D1? First of all, what is D1? That is the dividend that has just, the dividend that is expected to be paid. That is it. That is the dividend expected to be. This is dividend per share. Dividend expected to be paid in future. Dividend per share expected to be paid in future. Now, how do you get D1? How do you get this D1? For you to get this D1, colleagues, D1 is equal to D naught. D1 is equal to D naught, D naught, then times into one minus what? 1 minus not no 1 minus what? 1 minus sorry, 1 plus what? 1 plus G. That is how you get D1. That's how you get D1. It's not a minus. Don't put a minus, guys. Don't put a minus. What is D naught? What is D naught? This is the dividend that has just been where D1, someone, I know that someone in his mind or her mind is saying now it is becoming too hard. No, these things are not hard. Where D naught is equal to what? D naught is dividend per share that has just been dividend that has just been paid. So this is already paid, but D1 is that one which is not yet paid and is going to be paid in the future time. Okay, and when we are using Gordon's model, we use D1, we don't use D0, we use D1. D1 may be equal to D0 in a scenario where there is no growth in dividend. Because in a scenario where there is no growth in dividend, this G will be equal to 0. Where there is no growth in dividend. This G we are talking about here, G is, this is growth in what? This is growth. This is dividend growth rate. That is G. So in a scenario where there is no growth in dividend, then G is equal to 0. G is equal to 0. Okay, so what are we given from this question? What are we given from this question? What are we given? What are we given? We are given what? The current price. Okay, I have not defined the P. P is the current price. P, from the formula we have P, P naught. What is P naught? What is P naught? A P naught is the current market price. Current market price per share. Current market price per what? Current market price per share. The share we are talking about here is ordinary share. Current market price. Current market price. This is XDiv, not CAMDiv. XDiv. Okay. Okay. So what are we given from the question? From the question, we have the current price per ordinary share capital. So we are given P naught. So here you have P naught, which is 4. This is from the question, it is shillings 4,700. That is from the question. Then we are given what? We are given the dividends per share that has just been paid. Is this D1 or D0? Is this D1 or D0? You guys,
Did not. It's a did not.
You guys may be in library and you're just following. It's a D0, It's a D0, which is 362. 360. D0. So we have D0, which is 362. Then what else? We have the risk-free rate, RF. We have RF. We have RM. Historical dividend payments have been as follows. Dividend payments. If there is no growth in dividend, there is no give. But if you see that these figures are constant, if you observe and see that these figures are constant, these ones, then your G will be equal to 0. But you see these figures are not what? Are not constant. These figures are not constant. The dividend is not constant. The dividend is not constant. Because the dividend is not constant, it means that there is growth in dividend. And we must determine that G. We must determine that what? We must determine that G. How do we determine this? It's very simple. These things are not hard. They are not like the trigonometry you studied, those who did the math. It's not like the physics you studied in O level. So how do we get the growth? The growth rate, the growth dividend, the growth dividend rate, which is G. How do you determine this? We have, without complicating life, just try to master this formula. You are going to take square, okay, let me just write. Let me just hold on a minute. I first put this formula. I first put this formula. Then I will explain it. This is n minus 1. This is n minus 1. Okay. Then here you're going to get dividend, the latest the dividend in the current year. The current year, dividend in the current year. Dividend in the what? The latest over the earliest. Okay, so what is the current year? When you look at the question, what is the current year? 2017 and 2021, what is the current year? The current year is this one. So you put the dividend in 2021. You start with that. Dividend in dividend in 2021 over, this is in 2020, the current year or the latest 2021. Then over the dividend in what was the latest year, the first year. Sorry, what was the earliest year? Which it was 2017. 2017. Then whatever you get, the answer you get, make sure that the answer you get, you subtract 1. Is this really hard to recall? If you can recall all those songs in your mind, in your head, what about this small formula? Some of you know almost all the songs. At least you can also recall this. Just that you know that what we put on your numerator, you put the current year, then minus the first year. What was your first year? The earliest year. So what is your n? What is your n? N, how many years do you have? How many years do you have? How many years do you have? N. You have from 2017 to 2021. Those are how many years? These are what? 5. 5 minus 1, you get what? You get 4. You get 4. Don't put that one on calculator. 5 minus 1, you get what? You get 4. So divided by what is the dividend in 20? What is the dividend in 20? What is the dividend in 2020? What is the dividend in 2021? Someone tell me. The dividend in 2021 is what? When you say in the chat, I can't see. You just talk.
362.
362. Then over, what is the one in 2017?
309.
309. Okay, so do you know how to take now the issue is here. The issue is here. Do you know how to take the fourth root on the calculator? The issue is always here. Write 4 on your calculator, then press shift, then press on the power button, the one that has something like this on your calculator. You will see this appearing. Then once you see a square root appearing, open bracket. Write this 362 over 309. Close bracket, then press on equal signs. What do you get?
1.0403.
3 decimal points.
040.
Then
Then
-1.
minus 1.
Then -1. Then what do you get when you say -1? You get 0 0.0.
0.
All of are you getting this?
Yes.
So those who had 4, those who had 5, let me hope now you're okay.
Oh, I was suggesting that those that didn't see the root, they can use power 1/4. You get the 362 over 302 power.
Power
1
1
over
over 4. Okay.
Yeah, it can also work.
Okay. You open a bracket. But that's another. You open a bracket, then this over this close bracket, then power open bracket 1/4 close bracket, then equal signs. Okay, so that's how you get. Then when you multiply by 100 in a percentage, this is what? This is approximately 4%, isn't it? So that is how you get. That's how you get the growth rate. But please, as you get 4, you get n minus 1. Total number of years minus 1. Okay? All right, after getting this, you go back at your Gordon's model. You go back at your Gordon's model. From our Gordon's model, this one. From our Gordon's model, we can get KE. And KE will be what? Just substitute. It will be what was our D. Do we have D1? We don't have D1 yet.
We don't have D1.
Yeah. But we can get. I said D1 is equal to this. D1 is equal to this. So we substitute. Already we have D0. D naught was what? D naught was 362. 362. Then we multiply by 1 plus what? 1 plus 0. Don't put percentage, put 0.4. And what do you get on your calculator?
376.48.
This is 376.48. Okay, once you get your D1, you substitute here. So it will be 376.48 divided by what is P naught? P naught from the question? 4700. 4700. Then in the answer you get add 0.04. What do you get? You follow this.
In percentage.
On your calculator, first put open bracket, write this over this, close bracket, then plus 0.04. What do you get in decimal points?
0.12.
Like this, eh?
Yes.
Yes.
In percentage, it is what?
12%.
12%. So that is not your answer. That is not your answer based on the question. Based on the question, we need what? We need the beta. We need the equity beta. Remember, you're looking for, these are 15 marks. So you need equity beta. Equity beta, you use now the CAPM. From the CAPM formula. Already now from the CAPM. From the CAPM formula. From the CAPM formula, already you have the CAPM formula. You have the CAPM formula, just a minute, it is here. from this formula. You substitute, you have everything. What is KE? KE is 0. What? Okay, is 12%. This is like, this is, let me just do it down. What is RF from the formula? RF from the, rather from the question?
7%.
7%.
It is 7%. 7%. Then RM is 10%.
10%.
So this is 7% plus the beta that you need, plus the beta which you're looking for. Then into what? RM, which is RM is what? 10%?
10%.
10, yeah?
Yes, 10.
10 minus 7. So how can I get okay, when you're dealing with this, deal with decimal points. I think it can help you very fast. It will be, I need that. This is like 0.12. Another student can say like this. Then plus the beta into 0.1. 0.1 minus 0.07. Okay, so I need this one because I need the beta. I can take this one to the left side. It will be what? 0.01, 0.01 minus 0.07 is equal to the, when you get 0.1 minus 0.07, what do you get? Is it 0.03?
Yes.
0.03 beta. Let me open now, you're okay here. We are opening the brackets. 0.1 minus this, you get 0.03. So here it will be what? 0.05 is equal to 0.03 beta. You need beta. So how can you get beta? Beta will be 0. What? 0.05 divided by 0.03. What do you get?
1.67.
1.67. And that is your equity beta. You have 15 equity beta. It's very common in your exam. It's very common in your exam. Okay, so we are done with that question. You have your marks. Any question? Any question?
Yes, on part A.
On part A.
Yeah, that part, the last part you did know on the required part. The third one.
This
There is
one.
that that one. Where did you get your beta from? The 1.05.
Remember, you are looking at what? You are looking at portfolio. You are looking at portfolio A, isn't it? Remember from Roman 1.
Yes.
Are you seeing Roman 1? Roman 1, you need beta of portfolio A and B. So you will pick that figure from, we had done that. Are you seeing this?
Okay.
Are you seeing that? That is your beta.
Yeah.
That is your beta, the one you use when you are substituting in the formula here.
Thank you.
Is it okay?
Yeah, it is okay.
Any other question? This is like what we have discussed. Remember, it is a different question. a different question, but you see, the examiner can repeat. Just that I believe you can answer this. What is the risk? Find the risk. This is RF. RF with the required rate of return. You have KE. This is expected return. This is expected return. You have beta, you have the market. I think you can answer this. Here you are looking for the from your formula. From your formula, where is our formula? You just be substituting in this formula using CAPM. Using CAPM. Part A. Okay, using this CAPM. Okay. You have you are looking for RF. You have KE from the question. You have KE. What is KE from the question? Expected return. That is KE. Expected return. That is KE. This is 15%. 15%. So that is 0. What? That is 0.15. Then what is the RM? Are you given RM?
It is 14%.
Yes, it is 14%.
14%, which is what in decimal point? 0.14.
0.14.
Then what is RF? RF you don't have. Eh?
We don't have.
So can you get what is beta from the question?
1.25.
Now substitute in the formula. You don't have RF. Substitute. Where you have KE, it will be 0.15 is equal to RF. RF, I can say Y. I don't want to use X because here most of you are tired of that word. Eh? Okay. Then beta is what? Beta is when they say X, you think about right. RM is 0.14 minus RFY, which you're looking for. You see, this number is easy, but students mess up in just correcting like terms. They mess up. Eh? This is 0.15 is equal to Y. Y plus open bracket now. 0.125 times 0.14, what do you get? 0.125 times 0.14, what do you get?
0.175.
17, okay. Then minus 1.25 is Y.
It is 0.175.
Which is 0.18. Okay, around 75. Okay. But don't exceed the 3 decimal points. You'll be wasting time. Now correct like terms. This will be 0.15. You take this one to the left side, it becomes a negative, minus 0.175 is equal to what? Y minus 1.25Y. Okay? 0.15 minus 0.175, what do you get? Negative what?
Negative
0.25. 0.025.
Is equal to y minus 1.25. That is like 1 minus 1.25. What do you get? Negative what?
It's a negative 0.25.
So I need y. Y will be equal to negative 0.025 divided by 0.25 divided by negative. What do you get?
why it is 0.1.
0.1, which is approximately equal to what? 10%. The risk-free rate return is equal to 10%. That's how you get your RF if it's not given. Okay. You will use the same knowledge to get RM. Because here you're given KE, you're given beta, you're given RF. So you use the same knowledge. Here you're looking for beta. Now beta is not given. You're given KE, you're given RF and RM. RF is 10, RM is 12.5%. I believe that is very easy. You can use the same knowledge. This one we have discussed it. Compare the risks of each. Compare the risks of each of these and comment. Then comment like now this one. Basing on what we have discussed, let me use this one. Basing on this, what we have discussed, for you, you will have these betas. You will have these betas, beta for A and beta for B. Then when they say comment, for you to comment, you will need to say that you will just need to be looking at the beta. You'll be needed to look at the beta. I say that if beta is greater than 1, the portfolio is more risky. Than the market. So for portfolio, let's say A, since the beta when you're commenting, you'll be saying, can you hear me? I see network is, can you hear me? Guys, can you hear me?
Yes, we can hear you.
For commenting, you'll be saying what? For commenting or for comment? For Roman 2. For Roman 2, you'll be just saying that since beta for portfolio, for portfolio A, you put the beta. Is for portfolio A is since the beta for portfolio A is put the beta. It means that the overall investment risk is less risky than the market. That is if the beta is less than what? If it's less than what? Less than 1. If it's less than 1. That's the comment you can put. Then you also comment on B. Since beta for portfolio. Okay, for our question here it was B, because B was the one which had a beta less than 1. So since the portfolio since the portfolio A is, since the beta of portfolio A is, it was above 1. It means that the overall investment risk is more risky than the market. You use than the market. Okay, that's how you comment. That's how you comment. Also, you comment the same way. Okay, you are done. That is Roman 2. Then Roman 3, compare the risks of these portfolios to each other. Which portfolio is more risky? You will just be saying that portfolio you comment. Portfolio, let's say A is more risky compared to portfolio A, B, since it has a higher beta of, put the beta compared to or than the beta of portfolio B, which is you put the beta. That's how you comment. That's how you comment. Okay. So I think I'm done with even that question.
Yeah, hedging. Swala kwa hamna screen hiyo. Mada manyeti. Swali tunafanya so hedging.
But the theory about this, it is where all the risks are here. The risks that are the financial risks, then the terminologies, the indirect, then you have the common ones, the types of risks, the transaction risk, the translation risks, then the economic. Transaction risk is basically where the exchange is a currency risk associated with specifically with the time lag between entering into a trade and the contract. And then you see transaction risk. Assume you are doing a business. You import goods. When you import goods, for example, you import goods on credit. At the time of at the transaction date, there was exchange rate. Okay. Then the question is, what will be the exchange rate at the time of payment? So there is always that risk because these exchange rates keeps on fluctuating, keeps on changing. So there is a risk associated with what there is an exchange or the currency risk associated with specifically with the time lag between the time you enter into a transaction and the time you settle. Okay, that is transaction risk. That because you are purchasing goods on credit, at the time you are paying, the exchange rate may be different from the exchange rate at the transaction date. And that is a risk because to the side of the company, they can end up paying more. That is the side of a company. That is transaction risk. Then translation, it is always that risk that can come as a result of converting the financial results. For example, this is a company that has, this is a parent company. You guys, you're studying advanced accounting. You study these things of consolidation, I believe. For example, this is a parent company. It has a subsidiary in Kenya. A parent company in Uganda has a subsidiary in Kenya, but they have to consolidate. Now, because of the consolidation bit of it, you need to translate the foreign subsidiary into the currency of the home country. So there will always that risk as a result of you translating, as a result of you converting the financial results into your home currency. That is translation risk. And you guys in an exam just explain the way you understand these things. You may not directly recall the real definition, but put what you know. Put what you know. Put what you know. But in simple terms, that is translation. Translation. You're converting the financial statements of the foreign subsidiary from its local currency into the reporting currency. Then economic risk. Economic risk. This one is a long-term risk. A long-term risk that occurs where the market value or the future cash flows are negatively affected by unavoidable exposure to current exchange rate fluctuations. You may not be a person who imports or who exports. You may not be a person who have a subsidiary in the foreign country, but you are affected by foreign exchanges because you are running a business. Your cash flows may be affected. Your profit may be affected. Just imagine a scenario where the interest rate has increased. Imagine a scenario where there is a decline, or the dollar has appreciated or depreciated. There is always an impact generally to the economy. There is always an impact to the economy. So it can ideally affect you. So those are the things. Then when you how can you reduce those risks? You need to invoice foreign exchange invoicing. You can invoice in your home currency. For you say that all the transactions I need, if I'm to pay, I pay in Ugandan shillings. I don't want to hear about or if I'm to receive money, I receive in my home currency. I don't want to convert. I don't accept. You see, like some landlords, for them they say, as you pay me in dollars. Pay me in dollars. So it's you to sort yourself. You match receipts with payments. For example, you may be having a transaction in the foreign country, an import, and the other foreign subsidiary has another transaction this side. Maybe you expect to pay and you want to transact in Kenya. Same time you want to sell goods, you want to export goods to Kenya. So you can net off. That's what we are saying. Match receipts with payments and receive the balance. Then lagging and leading. Leading, you are paying now. You are paying now before the due date. Maybe basing on the what? Basing on the circumstances. You predict that the exchange rate may increase. The exchange rate may increase, so you decide to pay now rather than waiting for the 3 months. You pay now. Then lagging, you expect that the exchange rate may fall in future, and you benefit as an importer. Then if you predict that, you can delay to make the payment and pay later. That is lagging. Leading, you're paying now before the due date. But lagging, you're actually paying, you're delaying the payment so that the time you predict to have a favorable rates, you make the transaction around that time. Netting normally happens with groups that have different transactions in different countries. Okay, for the contracts, you enter into an agreement with a party that I'm going to pay you in the 3 months. And in the 3 months, we agree that in the 3 months, after 3 months, this should be our exchange rate. This should be the exchange rate to use. Okay, that is forward exchange. That's how forward exchange contract is. We predict you're going to pay me in 3 months. Okay, you're going to pay me worth $100 in the next 3 months. But we see that the exchange rate keeps on fluctuating. So we agree on the exchange rate. At the time you are paying me that money, what should be the exchange rate? We agree on that. We agree on the exchange rate, we agree on the time. That is forward rate agreement. Of course, there are calculations. Like the way you see, but if you can pass the theory, good for you. So guys, let me stop here. You keep reading. I know you will master these things.